Hey guys, welcome to It's Possible. I'm Opal. Today we're going to be talking about money management. So we're all adulting, and for most of us, we've never had a talk about money. No one has ever really sat you down and say, "Hey, this is how you manage money. This is how you deal with a mortgage. This is how you deal with car payments. Should you avoid debt? Is debt okay?" And what I want to share with you today is just some key principles in terms of why avoiding debt or paying off your debt early is so crucial, guys, to really building your wealth and really getting to the stage where you are financially stable. So, what do I have for you today? Today I'm going to show you, if you were to take a mortgage at a particular rate over a number of years, what would your mortgage payment look like? So that's the first thing, and you'll get that from most financial institutions. But what I have to share with you definitely is, how does paying off your mortgage early, making small payments to your mortgage, how does that put that money in your pocket, and how does that allow you to own your home a whole lot faster? Now, nobody's going to share this with you, but I'm going to break it down and show you how those monthly payments, those extra payments on your principal, makes it different. And it's not just a mortgage. What I'm showing you is applicable to a car loan, it's applicable to a consumer loan, it's applicable to unsecured loans. Like, once you pay on that principal early enough, you will be saving. So let's get started.
All right, guys, so let me share with you why you would want to pay off your mortgage early, or why you would want to pay off any loan early. So I have here a template, and in my template I have a number of values that I need to enter, and these values will tell me, for example, how much I would be paying per month if I had a particular loan. So let's say, for example, I had a mortgage of 10 million. So here we go. We enter 10 million here. We have a mortgage of 10 million. And let's say, for example, the interest rate on that loan is about 9%. No, I think mortgage rates now in Jamaica are averaging about 7 or 8%. So let's say, for argument's sake, it is 7% for my mortgage. And how long I have to pay for the loan. Let's say I have a 30-year mortgage. So the loan period in years, that's going to be 30 years. And the number of payment per year, let's say every year I make 12 payments per year. So it's coming out of my salary, or going to NHT and you're paying the money monthly over the counter. Whatever it is, you're making 12 payments per year. So we're going to put 12 here. Now, the start date of your loan. So we're in the month of October. Let's say we're going to start paying the loan in November. Let's say the 1st of November, the 1st of the 11th, and we're doing it 2021. Now, what this spreadsheet does is that it gives you an idea, one, of how much you would have to pay per month over the 30 years if you had a loan amount of $10 million and you're paying an interest of 7%. So that would give you a monthly payment of $66,530. And over the life of the loan, so for the 30 years, how much interest would you pay on that loan for your mortgage? You're looking at approximately 14 million. So over that 30-year period, you will be paying approximately 14 million in interest. Good? Now, those are the basic stats that when you go to the financial institution, this is what they will show you. What no one will tell you, that I'm going to share with you today, is how does making extra payments affect your mortgage, affect your car loan, affect whatever it is that you're paying back. So let's take a look first. When you make your first payment of 66,000 and change, let's look at how much actually go to the principal. So the principal is how much money you owe the bank. So that basic money that you borrowed, right? The original amount that you borrowed, how much money actually goes to that amount. You look at this, the first payment you make, only $8,000, $8,196 actually go to the principal. $58,333 goes to interest, which means you are making the $66,000 payment and $58,000 of it is going to the financial institution. That goes in their pocket. $8,196, that is your payment towards a principal. Now, when you look at the trend, let's say straight up to the end of the first year. So this is your 12th payment. So this is the end of the first year of paying your mortgage. That $10 million has only shifted. Only 100 and something thousand dollars have actually been paid to your mortgage. 696,000 have been paid to the institution as what? As interest. So you've paid almost, this is what, almost $700,000 in interest, and only 11,000 and mash has actually gone towards the $10 million that you borrow. All right, let's go into year two. So at 24 months, that's 2 years of paying for this loan. You have paid in interest 1.3, this is it, 1.386 million. This is like 14,000 short of 1.4 million. That's what has gone to interest. Now let's take a look at what actually goes to the principal, the money that you borrowed. So what you now owe is 9.7 million and change. So literally for that 2 year span, only $211,000 has been paid to the principal. 1.3, almost 1.4 million has gone to your interest payment. And this trend continues for many years to come. Let us look at 36 months. 36 months. So that's like 3 years time. So 36 months you have paid just in interest over $2 million, and 300,000 has gone to your principal. Now the reality is this is going to continue to be the case. No, take a look at this, guys. Take a look at this. This is 131 months in. All right, so 131 months in, that works out to be about 11 years. Little bit, a few months short of being 11 years. So let's say 132 months is 11 years. When you hit 11 years, right? Remember, you're paying 66,000 every month. Over $7 million has been paid in interest, and only 1.7 million has been paid on your loan. All right, so I think we all get the point, right? Most of what you're going to pay in the very early months of any loan is going to be pure interest. Now let's take a look at when you decide that, hey, you know what, I want to make some extra payments when I can to pay off this debt early. Now let's take a look. Without making any extra payment on a 30-year loan, total interest you're going to pay on that 10 million is almost $14 million. But let's say, for example, you found yourself with an extra $50,000 in a year after you started paying the mortgage. Let's say you found yourself with an extra 50,000 and you decided to pay that extra 50,000 on your mortgage. All right? Now, when you pay that extra 50,000 on your mortgage, if you take a look at it, the interest that you pay went down almost by 400,000, almost by 400,000. Now, let's say, for example, you didn't pay 50,000, but instead you made $100,000 payment to the mortgage. Look what $100,000 did to your mortgage. It took off almost 700,000 in interest. Now, not everybody has these large sums to pay over at once. But let's say you were consistent payment, right? Let's look at another scenario. A consistent payment of about $10,000 every month to the principal for the life of the loan. So I'm just copying down $10,000, right? So $10,000 for the life of the loan, and I was able to pay that every month for the time that I have. Now, one, instead of paying $14 million in interest, you know, paying $8.9 million in interest. All right? So that's almost $5 million saved. But not only that, I'm going to show you something. Look at the number of payments. Remember, originally we were going to pay 360 payments over a 30-year period. By making an extra $10,000 each month, you are able to cut that. You are able to cut that to 247 payments. So that is 113 payments, right? That you would have avoided in the future. So 113 payments that you would have avoided in the future. That means you would be able to pay off your mortgage. You would pay your mortgage off 9.5 years earlier, and that would put you in a good standing with an additional $5 million save for another investment. So think on these things, right? When you are looking at what you're borrowing, debt is something that can ultimately ruin your ability to grow your wealth. And if you can get out of debt early, it's the best thing can happen to you. And this is something you could do for a car loan, a consumer loan, you know, those unsecured loans that have absolutely no assets backing them. You could look at something like this to determine, you know, what it is that will be required of you.
So guys, I hope that was insightful. You know, I'm not just going to leave you without giving you some real tips that can help you on your way. So the first thing, when you're buying a home or any asset at all, you want to ensure that you save as much as possible for the deposit. Save as much as possible. When you save enough money for your deposit, you are driving down how much money you really need to borrow from the institution. So the more you have for a deposit, whether it's for your car, whether it's for a home, whether it's for a business, the more money that you have for your deposit is the less money you have to borrow, and of course is the less interest you have to pay back. So ultimately it's the more money you're able to save going forward. All right, so tip 2 I have for you. When you are deciding on buying a home, there is a general rule. There is a 30% that really your mortgage or rent housing should not exceed 30% of your income. And if you start edging over to have your mortgage payment or any housing payment, rental payments greater than 30% of your income, you're moving into the bracket of being considered house poor. And so that is also something that you have to be cognizant of when you are about to take on a mortgage and the institution works out the monthly payment for you, you really need to pause and say, is this 30%, 40%, 60% of my actual monthly income, and do I want to go that far? Because what you don't want to do, you don't want to take on a mortgage that is so high that you start feeling actually resentful for owning that home. Like it's almost like you hate the house because it is taking so much money out of your pockets and you can't really get to spend money on other things, right? So you want to ensure that as much as possible you are sticking to that 30% rule to stay within that bracket. Okay, here is your third tip. Well, based on the video, this one is a given. As early as you can and as often as you can, make payments to your principal. Now, most institutions are going to tell you that you have to wait for a particular window before you can make any payments to the principal because they're in the business to make money. So they don't necessarily want you to start paying to the principal until they have earned a certain level of interest. So for example, where I take my mortgage from, I have to wait 5 years before I can make a payment to the principal. However, one of the things that I do recommend is that you actually save those amounts so that when the time comes and you can pay down that amount to the principal, you would have accumulated it over time if you can. Now, another thing that I need to let you know, when you go to make the payment to the principal, you must tell the institution that this is a principal payment, and this goes for NHT as well. If you don't do that, what the institution is going to do, they are going to take the money and use it as a future interest payment. So instead of hitting off some of the principal immediately, they're going to put this money to come next month. They're going to put it towards an interest, that part of your interest that is being accrued over time. So you have to make that explicitly clear. Some institutions may require it in writing, that when you give them the money, you say, hey, I'm paying this $10,000. I need it to go to my principal. That's crucial, guys. All right, here is your fourth tip. You should ask for an amortization schedule. What is that big word? You see what I just showed you? That spreadsheet that shows you how your payments are distributed in terms of interest and principal when you make a payment on a monthly basis. You're entitled to that. You should ask the financial institution to print it out, send you an email so that you know how your payments are distributed. Now, they won't give you the template that I have that says, hey, if you make this amount, how much is going to be taken off your mortgage. But you are entitled to see how your payments are distributed. So ask for your amortization schedule. So this is my fifth and final tip. Financial management, money management requires that you exercise patience. If you are going to be building wealth, buying assets, starting business, whatever you're doing, exercise patience. You need to ensure that when you make the decision that you're going to spend money, you evaluate, is this a need or is this a want? Can I save money towards it to achieve it in a year? Or am I so impatient that it needs to happen now? And I think that is what put a lot of people under financial duress, because we're so caught up into, we're following the Joneses. We have to keep up with the Joneses. The Joneses just bought this car. The Joneses just bought this house, right? And we want to ensure that nobody no better than me, right? You know, I'm keeping up. Yeah, I buy a car too. Yeah, I bought a house too. But is it a need or a want? Exercise patience. Evaluate it. Write it down. See how you feel in a week before you make that spend. Come back and look at your list and say, do I still feel the same way? Because sometimes we impulse buy. I am certainly guilty of impulse buying, right? And so the best way to kind of avoid impulse buying and regretting you spend your money, that I really didn't need that new dress, I really didn't need that pair of shoes, is to write it down on your list, think about it, and come back at a later time and say, is this a need, is this a want? Patience is important in building your wealth. It is very important. It's important that you think about how you're going to defer some things so that you're able to achieve others. So I hope these tips were insightful to you. And what I really want to hear from you, a part of saving and investment, what are some of the strategies that you use? Do you ever defer things to say, hey, the bigger picture is that I would love to open my own business in the next 2 years. I need to buy a second investment property. I need to buy a home. I need to go back to school. Are you using any specific strategies to ensure that you're saving up your money to achieve those goals? I'm going to do a video on this, especially as it relates to home ownership or buying assets. Some strategies that I have used to save money to ensure that I can achieve those goals. All right, so look out for that. So until next time, walk good, and I really, really hope that these tips were very useful to you. Remember though to subscribe, like this video if it was helpful, and drop a comment below about financial management. Give us some tips, share your tips with the other subscribers. Thanks guys. Bye bye.